Hi guys, welcome back to another video. Today we are going to be talking about the carry trade, or probably let me put it in a simple way, how to use the government bond to predict the NFP. You can also use it, with other type of market and every other thing, but you can use the government bond to actually do a lot of things in terms of knowing the direction of the market. So the simple term is what we call the carry trade. A carry trade is a forex strategy that involves borrowing in a currency with low interest rates and investing in a currency with high interest rates. The goal is to profit from difference between the two interest rates. So that is what we call the carry, all right? So in this case, we are going to be talking about the GBP USD. So we are going to be using two bonds. All right, we are going to be using the GB 10-year yield and the US 10-year yield. That is what we are going to be using. The GB 10-year yield refers to the yield on the 10-year UK government bond. All right, some people call it gilt. We also have the formula for gilt. It reflects the return investors can expect when they lend money to the UK government for 10 years. The same thing happened with the US 10-year government bond, all right? So this is the yield on the 10-year US government bond, which is also known as the Treasury, and it is also indicates the return that the return from lending money to the US government for the same 10-year duration. The profit can come from two sources, all right? One is the difference between the interest earned on GBP asset and the cost of borrowing the USD. The second one, which is also known as capital appreciation, if GBP appreciates against USD, the trader can convert their GBP back to USD at a profit. So these are things that a lot of people do. But for Forex traders, let me put it in a very practical way. We are having GBP USD. This year is NFP. You could see that on January 10, we could see that we are having unemployment rates. And look at the result. The result is very, very good, all right? Because the unemployment rate, the forecast was 4.2, the previous was 4.2, but they had a very, very good result, which is 4.1. It's reduced, all right? So that was a very, very good result. So, but how do you know that this is going to happen? And how can I say as a trader that I'm going to be bearish because USD is going to be bullish and I'm going to be bearish selling GBP USD before the time occur, before this actually happen? How can I say that? So one of the method I can use is the interest rates, all right, or using the carry trade. So I can overlay the GP 10-year and the US 10-year, overlay, put it together to make a single line just like this, all right? I've made it to an indicator like this. So I can put it two together to one line, to form one line like this. So when it formed one line and you could see it going down before the NFP, this is the NFP 1330, Friday 10, that is last month. That was last month. The price actually sold because we could see that the interest rate has been going down. The GBP is losing and the US 10-year is actually gaining. So what this actually means in the practical way is a lot of people are moving their money that they profited from the interest rate of GBP and they are actually putting it on the US. So if the US is gaining more money, they can establish a lot of jobs, all right? And we could see that from this line that, okay, US is gaining a lot of money while GBP is losing a lot of money. And the price actually sold, which actually reflects in the result of the NFP. So that's why I could predict that, oh, the market is going down generally on the NFP day. And boom, you could see that the market actually went down. You could also use it in other days, not necessarily for the NFP alone. And I'm going to show you this month too. You could also see that we have here February 7, we also have the interest rates. So the previous was 4.1 and the forecast was 4.1. So they said it's not going to change, but it's actually changed it to good. You could see it 4.0, which is actually very, very good. It means that there's some jobs that actually increased and we could see the US actually going up and the GBP actually going down if you are trading the GBP USD. So how can I say that here? Using the government bond, if I put the government bond line, the GB, the carry trade, for the GBP USD, you could see that before the NFP, this was actually going down, telling me that, okay, this is the result. USD is going to be going up, all right, and the GBP is going to be going down. A lot of jobs will be created in the US, while a lot of money will be moved from the GBP to the USD before the NFP, which a lot of things will happen with that money. So using this carry trade, you could tell the direction of the market before it actually occurs. So you could see that it's actually spiked up here, but you already know the direction. You know that it's going to go down. So you can either use a sell limit, or you can probably allow it to take stop loss before selling it. If you have tools like Bookmap, Ninja Trader, etc. that we've talked about, you'll be able to do this. So, and you'll be able to sell using that for entry. But for the general direction, you already know the direction of the market if you are using the carry trade. So these are the few examples of the usage of the carry trade, which is actually very, very beneficial. You could also see some other days it works very fine. You could see this actually going down. The market went up, takes out liquidity, and it started selling. So it works on a daily basis, and you can also use it for the NFP. So I'm going to stop here. I don't want to make the video long, but I hope you enjoyed this video, and probably you can try it out. If it works for you, let me know. Goodbye.